Bismillahirrahmanirrahim. This is the seventh video on Introduction to Oil and Gas. In this video, we are going to talk about the acquisition of mineral interest in property. These are the topics that we are going to cover in this video. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on oil and gas accounting. We will start with explaining what property is and how it relates to mineral interest. Property includes land or any associated permanent fixtures like building or home. Oil and gas is part of the land, so oil and gas mineral rights are considered a form of real property in most countries. Minerals belong to the government, but in the United States, ownership of minerals was granted to the surface owners, and this type of ownership is called fee simple. There are two legal ways of transferring the ownership. One is through a will, and the other is through a sales deed. The ownership of the property is stated in the will or deed that delineates a specific piece of property on the surface with a certain amount of certainty, and it may include mineral rights below the surface too. There are four main types of ownership with minerals, also called property rights, and let us talk about each one of them in the next slide. Ownership is the exclusive right to possess and use the property. Transfer of ownership means transferring the right to use that property. So different types of ownerships have different types of property rights. First is called a fee simple. Fee simple is the absolute ownership of the property for an indefinite duration, and they own the rights to both the surface and the minerals. So a fee owner has the right to grant mineral lease. The second type of ownership is severed minerals ownership. In case of severed minerals ownership, the mineral rights are owned separately from the surface right ownership. Such type of ownership is called split estate. In case of split estate, the fee simple owner transfers ownership of only the subsurface minerals or just the surface rights while keeping the minerals. When the fee simple owner keeps the mineral rights but sells the surface land, that's when the mineral rights are severed or split from the surface rights, and the person who owns the mineral interest is called the mineral owner. Interestingly, the mineral owner is entitled to the use of the surface as necessary for recovering any minerals below the surface. Next, we are going to talk about surface rights. The owner of the surface rights has only the rights to the surface land and the associated fixtures like building or house. In this case, the surface owner does not have the right to grant an oil and gas lease. The last type of ownership is the royalty ownership. The royalty owner has the right to receive a royalty or a share of production, but they cannot grant an oil and gas lease or receive the associated bonuses on rental payments. So there are four types of ownerships. We have fee simple, which is absolute ownership of both surface and subsurface. We have severed minerals, where there is separate ownership of the mineral rights and the surface rights. We have surface rights, that is just separate ownership of just the surface, and the last one is the royalty ownership. Oil and gas companies have economic interest in the subsurface minerals, and this gives them the right to mine the minerals situated beneath the surface of a property. Oil and gas companies can acquire mineral interests by lease agreement with the fee simple owners or from the several mineral owners. Let us talk about mineral interest in the next slide. A mineral interest is an economic interest in subsurface minerals that gives the oil and gas company the right to mine the minerals situated beneath the surface of a property. When the owner of the mineral rights, fee simple or severed minerals owners, enter into an lease agreement or contract with the oil and gas company, two types of mineral interest are created: a working interest and a royalty interest. Next, let us talk about working interest. Working interest is the transfer of ownership from the subsurface landowner to the oil and gas company through a lease that allows them to explore, drill, and produce oil and gas from the land. So, suppose Mr. A has the mineral rights and he leases the property to company B. So Mr. A will have the royalty interest, conventionally suppose it is 1 upon 8, and company B will be having the working interest of 100%. The company B will also have 7 upon 8 of the revenue interest. There are three main types of working interest. One is the operating working interest. The operating working interest owners include the persons who run the operation as an oil or gas investment. The operating working interest owners handle the cost of operations and the payments to holders of royalty interest. Non-operating working interest, and this type comprises of ownership interest in the well or lease or other production areas with no responsibility to operate or pay the operation cost of a producing unit. Then we have the carried working interest, and this type comprises a partnership between different parties who own a working interest in a well. Several parties can share their working interest through a joint venture, a partnership in which a group provides the required finance to keep a well functioning. Investors are not required to participate in daily activities. They pay upfront, and when the production starts making profits, they receive a share of the revenue generated. Royalty interest is created by lease agreement but the royalty interest owner is not responsible for the exploration, development, or production of the property. The royalty interest is retained by the owner of the mineral rights. That owner enters into a lease agreement with another party. He receives a specified portion of the minerals produced or a specified portion of the gross revenue from selling the production, free and clear of any cost of exploring, developing, or operating the property. However, the royalty interest owner is responsible for any severance or production taxes assessed on his or her share of production from the property. When the amount of royalty is subject to negotiation, historically a 1/8 royalty has commonly been paid. Let us see how the royalty interest owner and oil and gas company calculate a royalty and working interest in an oil and gas lease. Suppose there is a rectangular piece of land and we are going to calculate the working interest and the royalty interest before the lease and after the lease. I would like to repeat that the landowner is also known as lessor and is the royalty interest owner as well, while the lessee is the oil and gas company. So the working interest owner is the person that pays for the expenses, and the net revenue interest is what the revenues are. Net revenue interest or NRI is the percentage of production revenue that an operator or investor receives and is calculated using working interest amount and then by deducting royalty interest. Another term that you should know before making these calculations is the concept of grand bargain. Grand bargain states that the lessor before the oil and gas owns 100% of working interest and 100% of net revenue interest. The lessor gives an oil and gas company 100% of their working interest and only keep a small percentage of the revenue in most cases. And the reason is that the oil and gas cost, drilling and exploration require very specialized engineering and technology. It is very risky and it costs millions of dollars that the landowner cannot afford. It is because of this reason the landowner opts to lease the land to the oil and gas company. In the early leases, the royalty payment was 1/8 or 1/8 of net revenue interest. So the lessor owns 100% of the working interest and net revenue interest before the lease. And the lessee owns 0% of working interest and 0% of net revenue interest before the lease. After the lease, the lessor owns 0% of working interest and we assume he has agreed for 1/8 of the royalty interest in the net revenue, while the lessee now he owns 100% of working interest and 7/8 of the net revenue interest. Now, the lessor gives 100% of his working interest in exchange of a royalty fraction, that is 1 upon 8. So the lessor is going to own 0% working interest, and they will also own 1/8 of the net revenue interest. Moreover, the lessee owns 100% of the working interest and 7/8 of the net revenue interest. So if we calculate in terms of percentage, this will be equal to 12.5%, and this will be 87.5%. If the royalty interest is not 1 upon 8, but suppose let us make it 3 upon 16 in place of 1 upon 8. So there will be no change before the numbers or percentages before the lease, they will remain the same. However, after the lease, the lessor is going to again have 0% working interest, and they will have 3 upon 16 of the net revenue interest, and that is equal to say 18.75%. The lessee is going to own now 100% of working interest and 13 upon 16 of the net revenue interest, that is 81.25%. Now the calculation will be a bit more complicated if the lessor don't own the whole piece of land but only a section of it. For example, the landowner owns not this whole piece of land but 25% of this land. And let us assume that the total area of this piece of land is 640 acres. And there is a government regulation that there can be only one well in a total area of 640 acres of land. Then there will be a pool of owners, and all these owners are included for the payment of royalty. So the lessor who owns 25% of the total land, so he will be having 160 as his part of a share of land, and if the royalty continues to be as 1 upon 8, so this will be equal to 1 upon 32, that is equal to 3.125% of the total net revenue interest. So the formula is net acres divided by the unit acres times the royalty interest that is going to be given to the lessor who owns this much of land. A working interest can be either undivided interest. Undivided interest exists when multiple owners share and share alike according to their proportion of ownership in any minerals severed from the ground. So let us look into an example. AB Oil Company enters into an agreement to lease 640 acres of land from Y Farm for 1/4 of royalty interest. AB has 100% working interest. Now AB Oil sells 50% of working interest to Q Company. So AB Oil Company and Q Company have undivided 50% working interest for each. So they each will get 50% of exploring, developing and producing the property. They will each receive 50% of 3/4 of gross revenue. Why 3/4? Because 1/4 is allocated for royalty interest. A working interest can be a divided interest as well. And this exists when specific parties own specific acreage, minerals, or equipment. Like suppose AB Oil Company enters into agreement to lease 640 acres from Y Farm for one-fourth royalty interest. AB has 100% working interest. Now AB Oil Company sells 50% of working interest to Q Company. So in this case, okay, AB Oil Company, they sell not 50% of a working interest, but rather they sell 100%. There is an error over here. They sell 100% of working interest in 50% of the property. So if it is 50% of the property, that means it is equal to 320 acres. So now AB Oil Company and Q Company, they have 100% of working interest in 320 acres each, or one half of the original acreage. So AB Oil and Q Company are responsible for paying 100% of the cost of exploring, developing and producing their 320 acres, and each would be entitled to 100% of 3/4 of the gross revenue generated from the 320 acres. So whatsoever 3/4 of whatsoever is generated on this 320 acres, and whatsoever is 3/4 of whatsoever is generated on this piece of land. And AB Oil Company and Q Company are responsible for paying Y Farm one-fourth of the gross revenue from each respective 320 acres of property. So as of now, this is all about working interest, and now we are going to talk about royalty interest. There are three main types of royalty interest, although we will be talking about others as well. One is overriding royalty interest, non-participating royalty interest, and production payment interest. And we are going to start with overriding royalty interest. Overriding royalty interest is created from the working interest. It is a shipping and oil and gas lease that grants the owner the right to explore and drill to produce oil and gas. Working interest owners are obligated to pay a corresponding percentage of the cost of those activities. So, unlike a mineral owner who gets the share of the production free of any cost, the working interest owner has to pay the percentage of the expenses based on the percentage of working interest owned. Just keep one thing in mind, that the working interest owner is paid the production revenue after the royalties are paid, so they are also entitled to a share in production with other royalty interest owners. Overriding interest is similar to other royalty interest, and it is not responsible for the cost of producing the oil and gas, but it only shares in the production of the oil and gas as long as the associated lease is in effect. So, unlike minerals, which last in perpetuity, an override is tied to the lease. So, once that production stops and that lease expires, the override also goes away. So, let us look into an example like Mr. A has the mineral rights and he leases to company B. Mr. A has the royalty interest and B has the working interest, and now company B transfers the working interest to company C and company B retains the overriding interest. So Mr. A has the royalty interest, B has the overriding interest, and C has the working interest. So if in this example, if Mr. A has leased his property to B after retaining 1/8 of royalty interest, and B subsequently conveys to C retaining 1/7 of the royalty interest. So the cost and revenues are going to be shared as follows. Is A and B, both of them are going to share 0% of cost. A will be having a royalty interest of 1 upon 8 of the total revenue, and company B is going to have 1/7 of the, now the working interest is 7 upon 8. So he will be having, B company will be having 1/7 of 7 upon 8, and company C is going to have 6/7 of 7 upon 8. So we know that oil and gas companies, they lease subsurface rights from mineral owners through a working interest lease to explore, drill, and produce the mineral reserves. In exchange, the landowner receives a royalty interest in the mineral estate and has the first right to receive revenue and retain ownership of the interest after production stops, or when the lease expires, the interest reverts to the mineral interest. Overriding royalty interest is a portion of the working interest. So the working interest value is the major determinant of the value of overriding interest. Holders of overriding royalty interest have no ownership rights to the minerals under the ground, but a non-possessory undivided interest. Because overriding royalty interest entitles the holder to a share in the production, not the mineral lease. So when the wells are no longer economical to produce, the overriding royalty interest lease expires. The working interest owner incurs all of the cost associated with exploration and development activity. All of the profits, revenues minus cost, go to the owner after the revenues are paid on any share in the mineral rights leased to third parties. Unlike a working or royalty interest, an overriding royalty interest cannot be fractionalized. It is an undivided, non-possessory right to a share of the production, excluding the mineral leases production cost. The oil and gas companies grant overriding royalty interest to investors, geologists, landmen, lawyers as compensation for their services. Holders of overriding royalty interest are also called the landowner's interest and have executory rights over the mineral rights. They receive a signing bonus, lease payment, and royalty payment on production based on their proportional ownership in the mineral rights in exchange for leasing ownership rights. So, since overriding interest is a percentage of a working interest lease, that's why it is also called carved out overriding royalty interest. The overriding royalty interest value is based on production on the acreage leased by the working interest. For example, a geologist is confident that their 100,000 acres of land will produce oil. The exploration and production company gives him a 5% overriding interest in exchange for his geological report. So the net revenue interest is working interest minus royalty interest. The royalty owner receives, suppose, a monthly royalty of 25% of the monthly proceeds. So this is the royalty interest, and the sales proceed for the first month is, suppose, say 1 million. So if the royalty is 25%, so the net revenue interest is 100 minus 25, that gives us 75. So 1 million minus 250,000, that is 750,000 monthly is the net revenue interest. The geologist would then receive a monthly royalty check on 5% of this net revenue interest. So overriding royalty interest is net revenue interest times his percentage, that is 5%. So 750,000 times 5% will be 37,500. Let us look into some scenarios in this regard. And the first one is like oil company takes an oil and gas lease from Sara, the mineral owner. In the lease, Sara retained a 12.5% royalty interest. Mineral royalty interest. So now oil company owns the rights of the balance, that is 87.5 of the revenue. Now as 12.5% was retained by Sara. As compensation for identifying the drilling locations, oil company assigns a 2% overriding royalty interest in the lease from Sara to the geologist Abdul Rahman. So Sara is going to have 12.5% of the royalty interest. Abdul Rahman, the geologist, is going to have 2% of his overriding royalty interest, and now all the oil company is left with 85.5% of the net revenue interest. Let us look into one more scenario. The landman is speculating that oil company will be interested in leasing minerals owned by Sara. The landman, before the oil company, contacts her first and leases Sara's minerals. The lease provides for a 12.5% royalty, and this will be given to Sara. Oil company wants to drill on Sara's minerals, but now they have to negotiate a deal with the landman, who agree to assign the lease to oil company and reserves a 5% overriding royalty interest. So now Sara still has the same royalty interest of 12.5%. Landman has an overriding interest of 5%, and the oil company has a net revenue interest of 82.5%. So an overriding royalty interest is carved out of the working interest from the oil company share of production. It is not ownership in the minerals, but in the proceeds from the sale of oil and gas. It is free from the drilling and completion cost, and it is tied to the oil and gas lease. When the lease expires, so will the overriding royalty interest. Next, let us talk about the second type of royalty ownership, that is the non-participating royalty. A non-participating royalty interest owner has a right to all or a portion of the royalty from gross production, but does not have the right to execute a lease or receive a bonus or any delay rentals. And non-participating royalty interest holder neither have the right to produce the minerals by himself, nor they are responsible for the operational cost associated with producing production or oil. And non-participating royalty interest has fewer rights than a regular mineral rights owner, as they do not have the right to make a decision related to the execution of leases. Other mineral right owners generally have the right to execute a lease, receive a bonus, or any delay rentals. Without production, non participating royalty interest has no value since there is no revenue. However, these royalty interests are created out of the mineral estate and become a significant burden against future production streams from the royalty interest. Let us look into a scenario in this regard. Assume XYZ oil company is going to drill. They and mineral owner are certain they will strike oil or gas. The mineral owner happens to need extra cash, and since the well is not yet producing, therefore no royalty checks are being sent. The mineral owner carves out a small percentage of his interest as a non participating royalty interest to go to an investor B, who in return gives him a lump sum payment of 10,000. So, when and if the well is going to produce, the mineral owner will receive the income and from his remaining royalty percentage, while the non participating royalty interest owner be opposed the the investor B will begin receiving income for his share from the lease agreement rather. So the good thing of carving out non-participating royalty interest is that the mineral owner is not in a debt and the investor B owns a non-participating royalty interest in an oil and well. So it is a win-win situation for everyone. Next, let us talk about production payment royalty interest. And it is similar to overriding royalty interest and is usually created from the working interest. However, it does not bear the cost of production. So the difference between the production payment and overriding royalty interest is that the production payment terminates upon the payment of the specified sum of money and will not go through the entire lease period but have a finite time associated with it. If a production payment is payable with money, the payment is typically stated as a percentage of the working interest share of revenue. If it is payable in product, payment is typically stated as a percentage of the working interest share of current production. So, Mr. A has the mineral rights and he leases it to company B. Now, Mr. A has the royalty interest and company B has the working interest. Now, company B transfers the working interest to company C and retains the overriding interest. So, company B has the overriding interest, A has the royalty interest, and C has the working interest. Now, C company further carves out or sells out the production payment to company D for cash. So now company the landowner has the royalty interest, company B still holds the overriding interest, company C has the working interest, and company D has the production payment interest, and they are going to be paying as long as the money is not paid off, or if they are going to share it as a percentage of the production unless they pay the percentage of the production. Next, let us talk about the joint working interest. Now, due to capital intensive, high risk nature of developing oil and gas properties, companies routinely combine their capital and knowledge in joint operations to share the cost and reduce the risk. These sharing arrangements usually involve the transfer an operating interest or non-operating interest by one party to another in exchange for a contribution to the project. In a joint working interest arrangement, one of the parties is designated as the operator of the property, and all the other working interest owners are referred to as non operators. The operator manages the day to day operations of the property. So, both operator and non operators are responsible for paying the proportionate share of any cost incurred. Next, let us talk about net profit payment interest. A net profit payment interest is a percentage of the net profit from the operation of the lease. The net profit interest entitles the owner to receive revenue only when the operations yield net profits. So, net profit interest is a non working interest created on onshore property, typically from the working interest. The allowed deductions from gross revenues to calculate the net profit are usually specified in the lease agreement. The net profit interest owner are not responsible for any portion of losses incurred in property development and operations. A carved out net profit interest is created when the working interest owner sells or transfers the net profit interest and retains the working interest. So Mr. A has the mineral rights and he leases the land to company B. So A has the royalty interest now and B has the working interest. Now company B carves out a net profit interest to company C. So company A, Mr. A has the royalty interest, company B has the working interest, and C has the net profit interest. Next, let us talk about the net profit interest on offshore property. Offshore is the type of interest that the government, as a mineral rights owner, often retains when leasing an offshore block to a petroleum company. So we have the government is the owner of the mineral rights, the government leases to company B, and government is going to have the net profit interest and company B is going to have the 100% working interest. Next, let us talk about the pooled or unitized working interest. So, pooled or unitized working interest is created when the working interest as well as the non working interest in two or more properties are combined. Each interest owner owns the same type of interest but with smaller percentage in the total combined property as held previously in the separate property. The properties are operated as one unit, resulting in a more efficient economic operation. So this completes part 7 of introduction of oil and gas, where we talked about the acquisition of mineral interest in property. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. And one last thing before I go, if you have any suggestions for future topics or any feedback, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. I am waiting for your comments I'm waiting for your questions and inshallah I will reply you back. Thank you for listening and happy learning.